All right, I've posted a worksheet that shows how betas are calculated, and I wanted to attach a video to sort of walk you through the process as well. A beta is actually a pretty simple calculation, and it's meant to measure the covariance of the rate of return on a particular stock with the rate of return in the stock market. And it uses the past as a predictor of the future. Now, that's a lot of gobbledygook, but I'm just going to walk you through how we got the numbers. The capital asset pricing model, which is the model that uses beta, is basically says that the rate of return on stock K is equal to an intercept term called alpha plus the market risk premium for the entire stock market times the beta, and the beta measures the return of the stock K relative to the return on the average stock. Okay, so if a beta is 1, then the return on K would be equal to alpha plus whatever the market risk premium is, and that's the average rate of return for the average share of stock. All right, we're going to use actual data and just go through this. So in the next sheet called SPY and Amazon data, I calculated the rates of return. All right, so we got stock data for Amazon, and that's just, I picked Amazon because I'm doing a lot of other work with Amazon. And SPY or SPY is the Spider ETF, an exchange traded fund that essentially is a sort of a mutual fund that buys all the shares in the S&P 500. So it tracks the S&P 500 perfectly. There's a little bit of really random variation, but bottom line, it tracks the S&P 500. So now I've got a measure of the entire stock market, and that's SPY, and I got a particular company I want the beta on, that's Amazon. So looking at the Amazon data, I did monthly, weekly, and daily data, and this is just the monthly price, and I went up through June. I have 5 years of data for monthly returns, and I have a couple of years, well, actually the same period of time for the weekly returns, and I gathered a whole bunch of daily returns, all of them going back over the last 5 years. All right, so to calculate the return or the monthly return, at the beginning of May 2017, SPY was selling for $241.44. 1 month later, it's $243.78. So the percentage change in value would be right around 1%. Okay, that depends on how many decimal places you take it out. So that's what I've calculated over here in columns N and O, is the percent change for 1 month for SPY and Amazon. And if I take this back for the 5-year period, I can then use regression analysis to look at how Amazon's percent change moves in relation to SPY's percent change. Another way to do that is to simply graph it. If I make an XY graph, okay, which Excel calls a scatter chart, all right, so over the last 5 years, I know this isn't as easy to see as it could be, but that's why I posted this spreadsheet itself. You can see in general that the horizontal axis here is the stock market. As the stock market goes up, Amazon tends to go up. As the stock market goes down, that's the horizontal, Amazon tends to go down. And that's the same stuff that affects the stock market affects Amazon. If I took this data and drew a trend line through it, the linear trend line and ask it for an equation, this line through these data points, which is the line of best fit, can be represented by this equation. The value of y is equal to 1.4688x plus 0.0106. The 0.0106 is the point that it intersects the vertical axis when x is 0. What that says is x, the S&P 500, as it goes up, Amazon goes up by 1.4688 times as much. So if I got a 10% increase in Amazon, or in the stock market, I would expect a 1.47 times as much, or essentially a 15% rise in the Amazon shares. And if I dropped 1% in the average stock market, I would expect a 1.5% drop in Amazon. So that's how we actually interpret these results. This line, the y equals 1.47x plus 0.016. This constant term is alpha. The 1.47 is the beta. So that's all a beta really is a line of best fit that relates the rate of return for Amazon to the rate of return for the average share of stock. All right, so I actually did these ahead of time, and this is the prettied up version, and I threw in some explanation boxes in here. But some people like to watch videos, so that's why I added the videos by way of explanation. All right, so notice I get a beta of 1.4688 or 1.47 with rounding by using monthly data. If I use the weekly data, using the last 60 weeks, I get a much different answer. The beta is 0.8522. Now there's a reason for that. That's there's these two outliers. An outlier is just a really anomalous data point. Because of where they appear and the timing of them, they happen to really take that slope here and drag it way down. So that's just anomalous data. And if I was doing this for real, I would just drop that observation and drop that observation. I'd get a better fit. If I use the last 60 trading days, I get a different beta yet again. It's 1.10 or about 1.1. And that's the reason when you go out there and look in various data sources, you get different beta estimates. Some people are using 5 years of returns. Some people are using the last 180 days. Some people are using 2 or 3 years of weekly. It really depends on the time line that you're using to make this estimate. Now, in theory, you use the one that best predicts the future. But if you already knew what best predicts the future, there ain't much point in doing all this statistical mumbo-jumbo, is there? So that's why you get different estimates of beta. I think in my day, when I was going through school, we always used monthly because it was the most predictable. There ain't no right answer to that, but anyway, that's what a beta is. It's simply a regression line that relates the rate of return on Amazon to the rate of return on the average share of stock. All this variability off of the line, that's called random noise, or that's lack of fit for this. If you hold Amazon in a portfolio with all the other stocks, this stuff gets averaged out. So the randomness in these returns is offset by the randomness from other stocks. So that's why professional investors tend to focus on the beta, because you can, if you hold stocks in a portfolio, the beta works a lot Well, I won't say a lot better, but it works better. Anyway, that's where betas come from.